Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Tesla's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Tesla is an electric vehicle and clean energy company. Tesla's current products include electric cars, battery energy storage, and solar panels. The company's name is a tribute to inventor and electrical engineer Nikola Tesla. Elon Musk was not the original founder of the company, but one of its earlier employees. Tesla ranked as the world's best-selling plug-in and battery electric passenger car manufacturer in 2019, with a market share of 17% of the plug-in segment and 23% of the battery electric segment. In 2020, the company sold its millionth car. The Model 3 ranks as the world's all-time best-selling plug-in electric car, with more than 500,000 sold. Tesla cars accounted for 81% of the battery electric vehicles sold in the US in 2020. Let's get started with the model. This is a large cap company, 532 billion market cap. They're trading at $561 a share, and they have 949 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. Free cash flow is cash flow from operations minus capital expenditures. So you can see the company had a big negative in 2017, but they've turned it around. They have 1.8 billion of free cash flow in a trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they had negative net income every year except in the trailing 12 months. Revenue is a sales, and you can see their sales have grown a lot, from 11 billion to 28 billion. This is the company's income statement. The top line is the revenue, below that is cost of revenue, below that is gross profit, which is a difference between revenue and cost of revenue. So every year they do have positive gross profit, but the operating expenses are pretty high. So they had negative operating income in 2017 and 2018, but in 2019 was the first year they had positive operating income, and in the trailing 12 months it was a big positive. They also have other expenses, interest they pay in their debt, and taxes. So they did turn a profit for the first time in a trailing 12 months. This is a breakdown of their sales. So of the 25 billion in sales in 2019, 20 billion was from car sales, 869 million was from leasing cars. They also had 2.2 billion of other services. Services and other consist of servicing vehicles, vehicle insurance, and some other factors. The company also sells solar panels and other solar products, and the revenue for that was 1.5 billion. Their revenue increases a lot in every category except for leasing. It actually decreases from 1.1 billion in 2017 to 869 million in 2019. And this is their revenue, net income, total assets, and employees by year starting in 2009. The growth in their revenue is pretty amazing. 112 million. It hit 2 billion in 2013. It jumped up to over 10 billion in 2017, and it more than doubled since 2017. So they're growing at a really fast pace. They had negative net income every year, but it looks like in 2020 they're going to have positive net income. Their total asset base has also increased pretty dramatically, and also their employees. This is the company's statement of cash flows. The top line is operating cash flow. So you can see the company had positive operating cash flow in 2018 and 2019, even though they had negative net income. And they will almost break even in 2017 in operating cash flow. But they do have quite a bit in capital expenditures each year because they're constantly growing their business, buying factories and equipment. So their free cash flow is operating cash flow minus capex. So it was positive in 2019. So they do fund a lot of their business on equity and debt. On equity, they issued 400 million in 2017, 848 million in 2019, and over 7 billion in trailing 12 months. And they issue even more debt, 7 billion, 6 billion, 10 billion, 11 billion. But it looks like they're rolling the debt because they're repaying it each year as well. So I'll show you why their operating cash flow is positive with negative net income. So let's look at 2019. To calculate operating cash flow, you take net income, that's negative 775 million. Then you have to add back the non-cash items on the income statement. They reported a $2.2 billion depreciation expense onto its income statement, but that's a non-cash item, so they have to add it back to operational cash flow. They also had $898 million of stock-based compensation, also a non-cash item. That's when you pay employees with company stock. So even though they were reporting negative net income in quite big amounts, negative $2 billion, negative $1 billion, but they were operating with positive cash flow in 2018 and 19. That's why you should look at operating cash flow when you value a company or when you invest, because that's a better indicator of how well a company is doing financially. Because the income statement has a lot of non-cash items. It's more accounting, so it could be a little hard to understand, but operating cash flow is actual cash that went in and out of the business, and cash is king, as everybody knows. Let's look at a capital structure. They have $14.5 billion of debt and $8.2 billion of net debt. Net debt is total debt minus cash on balance sheet. So since their net debt is positive $8.2 billion, that means if they used all their cash on a balance sheet to pay down their debt, they'd still have $8.2 billion of debt remaining. And they have $7.5 billion of equity. And the interest rate they pay in their debt is 4.6%. The cost of debt is 3.4%. To calculate cost of debt, it's interest rate times 1 minus the effective tax rate. And 66% of their capital structure is debt, which means 34% is equity. The cost of equity is 17.5%, and to calculate cost of equity, we use the capital asset pricing model, and part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market, and their beta is 2. So the stock moves 2 times the market. So if the market goes up 5% in a given period, the stock should go up 10%. The beta is the volatility of the stock. The higher the beta, the higher the cost of equity. And their WACC is 8.19%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for that's $133 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $113 billion. We divide that by 949 million shares. And we get a calculated stock price of $120. They're trading at $561, so they're trading at a 368% premium. It's a sell according to the model. And Simply Wall Street gets almost the same exact valuation as me. I have 4 discounted cash flow models in this Excel file, and I used a model that provides the highest future free cash flow for this company. I also gave them a 6% perpetual growth rate. Usually with most models you give 2 to 3%, which is the long-term inflation rate, but I gave 6% for more significant terminal value. And my valuation was still a lot lower than where the company's trading at. So when you invest in a company or buy an asset, the value of that asset is the value of the future cash flows discounted back to today's dollar. That's how you figure out the value of an asset or a company. But stocks are different because sometimes investors push stock prices really high above to where they're worth because they think the company's value is going to be greater in the future than what the financials currently indicate. This is where the stock has been trading the past 5 years. The growth has been exponential. It's really been increasing the past year. The company did a 5-for-1 stock split in 2020. If you look at any numbers before August 2020, you have to multiply them by 5 to figure out where they're actually trading at that day. But currently it is trading at $561. The company has never paid a dividend and doesn't plan on paying a dividend in the future. Tesla's cars are the Model 3, a 4-door sedan, the Model Y, a compact SUV, the Model S is a 4-door full-size sedan, and the Model X is a mid-sized SUV. In 2019, the company offered insurance to only people in California, so I think they're going to roll out this program and start competing with the big boys like Geico. This is a chart by quarter of total production and sales by vehicle model. So you can see they started out with the Model S, 250 cars in 2012. And that ramped up pretty quickly to 2,400 cars in the following quarter, and now it's at 15,000 cars per quarter. Sales of the Model X was from 2015 to 2019, and they sold 120,000 units. Their biggest seller is the Model 3. It was only 222 units in 2017, and it jumped way up to 1,500 units the following quarter, and then way up again to 8,100 units. Then more than double to 18,000, then more than triple to 56,000. So you can see that car is the best seller. They sold over 700,000 units of that car. So to date, the company has sold over 1.2 million vehicles. So in 2003, Martin Eberhard and Mark Tarpenning were the two original founders of the company. And the two founders were influenced to start the company after GM recalled all its electric vehicle cars in 2003 and destroyed them. Ian Wright was Tesla's third employee. The three raised $7.5 million in 2004. Elon Musk contributed $6.5 million. There was a lawsuit, and the result of that lawsuit was they had to name 5 people as the co-founders, Musk being one of them. Tesla has been a party to 620 lawsuits, and some of these lawsuits result from Elon Musk's tweeting. Tesla has been the subject of many public controversies. It is ranked as the 14th most dangerous tech company. Several people have questioned Tesla's financials. Tesla seems to use many accounting gimmicks to show positive cash flow and quarterly profits. Tesla has made $300 million in fraudulent battery swapping technology. And these are just 2 of the examples. There's many, many more. Tesla is the most shorted stock. At one time, over 20% of the stock was shorted, and the short sellers have lost a lot of money. Tesla ranks as the worst among vehicle quality. Tesla had 2 recalls for its Roadster, 6 for the Model S, and 2 for the Model X. Tesla also did a recall for faulty parking brakes, and also another recall due to corrosion. Let's look at the financial ratios. The average PE in the market is 13.2, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 956, so they have a crazy high PE ratio. Average price of sales is 6, median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They also have a fairly high price to sales ratio. Average price to book is 4.6, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 71, so they're a lot higher than the median and average. Equity is assets minus liabilities on a balance sheet. Of the $7.5 billion of equity, $6.1 billion is tangible equity, the rest is intangibles. You generally want to have a higher percentage of tangible than intangible assets. Average interest coverage ratio is 12.8, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They're at 2.6, so they can cover their interest payments 2.5 times. EBIT is earnings before interest and taxes. Average ROE is 10%, the median is 11%. ROE is net income over equity. They're at 7%, so they're a little lower than average and median. Average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities, so they can cover their current liabilities with their current assets. Their current assets are $6.3 billion of cash, $1.3 billion of receivables, and $3.6 billion of inventory. So they seem to be fairly well capitalized because their free cash flow in the trailing 12 months is $1.8 billion, and their working capital, which is current assets minus current liabilities, is $1.4 billion. The best way to look at ratios to compare them to similar companies, I've done videos on Ford, Lee, NIO, Solo, Workhorse, and XPeng, all in the same industry as Tesla. And if Tesla has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are better in PE because the average is negative. Most companies in this industry have negative earnings, so they have negative PE. Their price of sales is also better than the average. Price to book is better than the average because the average is negative. Most have negative book value. Their current ratio is below average, but 1.1 is okay. ROE is above average. Their debt is pretty much average, and they're the largest company of this industry. They're larger than every other company combined. So to summarize, I do have them trading at a premium because their stock price is so high. That doesn't mean it can't go up. It can go up to infinity if investors keep pushing the price higher and higher. And their ratios are looking a lot better than they used to, and their financials are also improving pretty dramatically. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.